The clock on the wall says 1 o'clock. I'm Guy Adami. Dan Nathan, of course. We're sitting next to each other, folks. You believe
Opposite each other.
opposite each other. But this is Market Call, Dan Nathan. I don't know. We're opposite each other, but we are next to each other still.
Well,
but
if we were sitting side by side,
that would be odd.
This would be next to each
that
other.
would be odd.
That. Yeah.
Today's Market Call, by the way, is brought to you by FactSet, financial data and analytics powered by Tomorrow. Today, we are joined by Carter Braxton Worth of Worth Charting. And who else, Dan Nathan?
Hashtag Butters. John Butters. He is the senior earnings insight analyst over there at the FactSet. And we listen, we get to preview his earnings insight blog every Thursday
special
on Market Call. But today's Wednesday, and you often get yourself a little bit confused.
I get confused.
So we actually have him with us here. And he's going to go through just really all Q1 earnings season. We're getting towards the end of it, and he's got a lot of really good stuff.
Yeah, and this weekend is Memorial Day weekend.
Yeah,
so it means people have barbecues and stuff. So I'm going to say this before he comes here. Butters is going to be at some barbecue with a bunch of people that he's never seen before. And they're going to come up to him and they'll be like, you're Butters.
You're Butters.
And he's like, you're damn right I'm Butters.
All right,
I mean, that's all I'm just saying.
All right,
interesting day in the market here, by the way. Debt ceiling seems to be, again, the top of mind. The S&P is going from 4,200 to 41-ish hundred in the course of a day and a half. I mean, that's the type of moves we've seen. But the thing, and we're going to talk about all this stuff, the thing that I find most interesting today is the VIX, which didn't care at all, for some reason, seemingly cares today, Dan Nathan. How are you, by the way?
Well, listen, and you've been saying this, actually, the closer we get to it and the sort of back and forth, at least is just from a sentiment standpoint. I mean, sooner or later, someone has to take note, right?
Mm-hmm.
And they're going to have to kind of put some downside protection in or hedging, whatever it is. And, there's a lesson I think that was learned this year, Guy, and definitely about the regional banks. And, this really struck me the other day when Jamie Dimon was talking at his analyst day. And when he said, I've been telling customers, I've been telling people, I've been telling other banks, he said, other banks, be prepared for higher rates for longer. And it's interesting. And it takes us all the way back to, you thought rates would go when the Fed said they were going to raise rates to battle inflation at the end of 2021. You were like, watch out here, people, because it's not going to be a couple and done. And the fact that these regional banks weren't hedging that risk, right, that they had on a mark-to-market basis, they're held to maturity securities. And I think that when you think about what's just going on right here, we go back to 2011, the last time we really had this sort of showdown, people panicked in that thing. There's been no panic yet. So long way of answering to your point, the fact that the VIX is above 20 still feels like that's just a lot of complacency right here. There's not a lot of prepping going on for worst case scenarios, in my opinion.
I agree. By the way, I still think they're going to get something done. Now, whether or not the market rallies on the back of that remains to be seen. But the debt ceiling, to me, as important as it is for not only our economy, but for the global economy, in terms of the market, I still think it's a bit of a sideshow, because I think what people come to the realization, and we talked about it on Monday, I believe, that the macro is what matters, and the macro environment isn't all that great. So we'll talk about Biden negotiators set to meet amid debt default impasse. I love the way they spell that with 2 S's and an E. It's very French, but that's nice and interesting. But I think the realization is going to come in the form of, wait a second, we got through this, but you look across the landscape and there's still problems out there.
Yeah. So you and I were on Fast Money last night, and we had a great conversation with Rebecca Pedersen.
Mm-hmm.
We had, Karen Feinerman, and we had obviously the illustrious Melissa Lee.
Sure.
And we were talking about some of this stuff, but we were talking about it through like slightly different lens. And, one of the things that I mentioned this is like, look at how these resource stocks trade. Like,
awful.
So if they can pull up like an FCX, okay, in copper, you saw where copper's trading. If you look at an Alcoa, look at a letter X, look at coal. It trades. Those all trade like the globe is going into a recession. And then, we spent some time talking about the fact that the Chinese are shutting down some, public, music fairs and
very quietly.
Okay. So you think about that Q1 GDP print of 4.5%. And I made this point last night on Fast Money. In 17, 18, and 19, Chinese GDP was, nearing 7% or so. It's between 6.7 and 7%. Well, it was 4.5% in Q1. And if they start shutting things down here, I mean, there's a month left in the quarter. I mean, the China reopening trade could be just a total dud this year.
The market has said that for quite some time. I mean, when the China reopening came out, the headlines, you had that initial spike in a lot of these stocks and a lot of the commodities, and that was as short-lived as anything. I mean, everything gave it all back. And to your point, steel prices have been cratering. The The resource stocks don't trade particularly well. I thought Alcoa would hold this little bit of a double bottom. It hasn't. So that's telling a story. The S&P is telling a story as well. Might as well look at it because the moving averages a flat line. I'm sure Carter has some ideas on this and some thoughts, but we traded right up to those levels effectively we saw in February. Seemingly I say seemingly because again, a lot can happen.
Yeah.
And here we are still sort of stuck in the middle of this range effectively.
Yeah. Well, I mean, to me, that 4,100, 4,200, we've been talking about it for, 6 or 7 weeks right now. All right, let's bring him in. You mentioned him, Carter Braxton.
Oh, I like Carter.
Of Worth Charting here.
Carter, I do like Carter, by the way.
How are you, bud?
I'm good. You guys are both next to each other because you're pretty close proximity, 6 feet away, but you are sitting opposite one another. It's true.
All right. So thank you.
True, but you are next to each other too. Like I'm not next to you. You guys are next to each other. You're sitting opposite.
This is why we bring in the big guns like
he's the arbitrator.
And then Butters on a day like today. Star Power, not us. It's kind of like just last night, Carter. Guy and I sit down on the same side of the desk at Fast Money. And last night we were next to each other.
Yes, we were.
On the other side of the desk was Rebecca and Karen. And I looked at you and I said, we're a little bit outgunned here.
We're totally outgunned.
Yeah,
and we're outgunned. Listen, if it's Butters and Carter
outgunned
again. Unless we're playing like dodgeball. And then I think we'd kick their ass.
Oh my God! Can you imagine? Are you a guy? Do you aim for the head? What do you do?
100%.
Always, because you think you get a knockout blow, Carter. You're a head. You're a head guy too.
A good game. Sure.
All right. So Carter, let's talk a little bit about this S&P 500. We had that like mild breakout, okay, and it got rejected. When you see such a tight range like we've been in for 6 or 7 weeks, okay, and then you see a little bit of a false breakout. I know you're not going to say that's not particularly meaningful because it was up above there for like a hot minute here, but then you see this sort of 100-point pullback here. Is this significant to you, especially when you consider the headlines that we're like ping-ponging back and forth here over the next few days?
Right. No, and the key, of course, is that the equal weight S&P and so many other aggregates were never even moving up as you got that little inch above the line there. The truth is we're still just stuck. The market is a pair of twos, but what's happening under the surface is getting worse and worse. I just don't like the setup.
I look at it here and say, the moving averages are flatlining. I think people are coming to the realization, just my opinion, Carter, that wait a second, maybe the macro isn't that great. It's been 15 stocks effectively, 2 as we've talked about, 15 stocks effectively driving this entire thing. The problem, of course, being they're all great companies, but the valuations have gotten stretched. And I think to a certain extent, we're seeing that today. What does this one-day move in the VIX mean to you, if anything at all? Because we haven't seen a move of this magnitude probably in a month and a half or so.
Yeah, I mean, the VIX is very sort of low relative to where it's been and due for a counter trend. It's up against its declining 150-day moving average on a VIX chart. I think the whole, this whole debt thing is a red herring. None of it's real. I don't think, again, that they will go over the side. That's what brinksmanship is. You get to the brink, but you don't do it. And so the reality is, so they get that solved. Does that have anything to do with the operating results of Foot Locker, which were poor, or Abercrombie & Fitch, which is up today? It does nothing to do with it. It has nothing to do with world steel prices or copper or corn. It has nothing to do with whether NVIDIA is good or bad. The whole debt thing is just nothing. I mean, because if they don't solve it, what? Oh, well, we'll just risk a 20% sell-off and take place all around the world when, quote, the most important country with the most important currency just plays politics with everybody's lives. Of course, they're not going to do that. If they are, then they're that stupid.
Yeah, well, it's interesting, and we're going to talk about retail here in the U.S., and we've been talking about it, I think, for weeks now, because a lot of the retailers that we started reporting last week, Walmart and Target, and some of the things that they talked about, I think initially, some investors kind of breathe a sigh of relief on the inventory front, that sort of thing. But when they look under the hood, there's some trends that aren't particularly great. And so bringing it back to this whole debt ceiling thing, people like us who stare at our fact set machines all day long, right? And we're looking at every headline and every tick pick and the things that matter to us, we're kind of, we're kind of over it. And I think we're all in agreement that something's going to happen. But if you're a consumer out there and you hear people like Janet Yellen, the Treasury Secretary, who they don't even know who she is until periods like this, and they start talking about how we're not going to be able to pay our debts unless this, that, or whatever. And they are literally talking about what could happen to the economy, what could happen to the stock market. That could have an effect on, I'm just saying, consumer spending, consumer sentiment in general. And that's one of the reasons why, they'll push it to the brink. And like, who knows the damage that happens between now and then. And if for any reason there is some sort of hiccup where we have a week or so where things go haywire, that 1 week has the potential, I think, to do a damage on the quarter guide. Do you is that something?
Listen, again, the U.S. consumer, I say this all the time. I never question their want to spend, because they've proven over and over again that they will spend in just about any environment. Question is, should they be spending? And we've spent a lot of time talking about debt levels, credit card debt, and all those things, and nobody seems to care about it. But to your point, people stop spending when they're scared, when something happens that scares them. And this might be it. Historically, it's been a stock market sell-off in a precipitous fashion where consumer spending stops on a dime. But if they continue to see this on the evening news each night with Dan Rather, that if we don't get a debt ceiling.
He was your guy? I was more of a Brokaw guy.
Brokaw guy?
Yeah, Carter, you were definitely a bro. Oh, no, Peter Jennings.
Yeah.
Carter was.
Well, Dan Rather took the mantle from Walter Cronkite. That's the real heavy.
By the way, as you know, Dan Nathan, now a minute's going to really matter.
Fine. We got time.
No, REM, their album Monster. Now, REM was one of the great bands in the 80s. They probably had a 6-year window where it was REM and everybody else. But off Monster, there was a song called What's the Frequency, Kenneth?
Yeah. And
of course, famously written about an encounter Dan Rather had on the streets of New York City. Back to you, Dan Nathan.
Yeah, fair enough. Right. Well, we just solved a lot.
You know who cares about that? Butters.
All right. Well, we're going to get to that in a minute here. All right. So, Carter, talk to us a little bit, because you had a call, I want to say about a month ago in Walmart. You said it was churning. It was at a level. It was, there was a little bit of a downtrend, but it was also at just another resistance level if you wanted to draw a horizontal line on a shorter term basis. And that kind of proved out a little bit. Guy has been highlighting the fact that Target on a relative basis has just been, a garbage. And then some of the things that you just mentioned, the Foot Locker, and there's been a whole host of other names that just don't act particularly well. So talk to us what you're thinking. We're probably at least 2/3 the way through retail earnings. We got a really big one tomorrow night, Costco, you want to look at, but let's think about like the XRT, the S&P retail ETF that tracks it, because I was looking at it on the set of Fast Money last night as we were talking about some of these retailers, and it just looks heavy.
It sure does. And it's a great aggregate because we know it's an equal weight or close to equal weight ETF with some 90 stocks, about 2.9 trillion, includes Amazon and Walmart, the two biggest, but Costco, Home Depot, and interestingly, they get the same weight as a Gap or an Urban Outfitters. Here's the chart. You see it there, no lines, no drawings. Let's put some in. You have a fairly well-defined trend line. And the question is, are we about to break that? Well, you could draw the arrow. I think we do. But what's important is how you have that perfect double top. You failed the December-January rally, right, into February high. February 2nd was the market high. It got right to that prior high of August, literally to the penny, and puts in a double top. You can annotate it with a double top, you see in the next iteration. And so the question is this going to break? Well, if we pull it back, let's keep the same setup, but give it a longer term look. And let's change it and put in a downtrend line. And so we're working into a point, and then let's go even further back and pick up the COVID low. And then final chart on an absolute basis, take a look at this. We're sitting at a break juncture. And of course, I could have moved that lower line up and show that it's already broken. But relative performance is particularly poor. We can get into that as well. This is not a good setup. And even though you get moves like Foot Locker that are down a lot, or today it's Abercrombie & Fitch up a lot. Just to talk about it, Abercrombie & Fitch. So, there are a lot of stores that just don't need to exist. So one could read the headline and say, Abercrombie & Fitch is up 25% today. That's one way to write the article. The other way would be this. Abercrombie & Fitch, whose stock peaked in 2007 at 85, before today was down 75% from its all-time high, but now is down only 65%. Meaning this stock peaked 15 years ago. Abercrombie doesn't have to exist, just like Gap stores. You could sell T-shirts anywhere. These are not enduring businesses. This peaked 15 years ago. Who gives a damn that it's up today 25%?
Although
Yeah,
I
if
will
you own
tell
it,
you, I bet you back in your day, Carter, you shopped regularly at the Abercrombie and Fitch. I can't walk in those stairs. There's one at the Short Hills Mall. I don't know
it's
what they have in there. The smell is
I can do that.
overwhelming.
Yes, you could
I'm
buy
going to call a bit of an
a
audible
mini
here, by the way.
fridge, and you
So,
could, yeah,
yeah.
store
So I'm
stuff.
sorry. So Aaron Rodgers yesterday had his press conference. If anybody cares, I thought it was pretty ridiculous. But let's call a bit of an audible. I want to pull up a target chart, if I could, Jacob, Stephen, and/or Amanda, because I want you to look at this $65 billion company. We're at pretty important levels here. If we can look at a target chart, maybe if we could stretch it out a little bit, you'll see exactly what I'm looking at. Huge support levels right here in this stock. Speak to me about potentially the importance of Target and what it potentially could mean to the broader market.
I mean, big one, right? I mean, now you're getting into real market cap, and of course, a general retailer, general merchandise, and really, in many ways, a pure one in the sense that it's not selling groceries like Walmart. And that one-day drop on the chart, which you see there, Walmart had the same thing. That was the single worst one-day drop since 1987 crash. That's epic stuff. And here we are, no better than we were then. What would be the thesis for buying this? It's not working. At one point, it looked as though it was bottoming. It's clearly not.
Yeah. All right. So let's focus. I think that this one, Costco, for so many different reasons in Carter. And I think that, when people kind of dissect the differences between Walmart and Target, it really comes down to who sells more groceries, right? And so the grocery business has been a good business in an inflationary environment, and they don't have the sort of inventory issues. They did have some sort of supply chain issues, and they did have some issues as it relates to price. But like Walmart, it's really benefited from getting people in there. Half their sales are groceries. Costco has a kind of similar sort of makeup here. From a fundamental standpoint, we often talk about the differential between valuation with Target and Walmart. The Costco is off the charts, right? And I mean, to me, so that's one, and it has something to do with obviously the membership model and everything like that. But talk to us about this one, because this stock also, Carter, is not making any progress. It reports tomorrow after the close. The implied move in the options market is only about 3%. And if I'm looking at the 52-week range, a year ago, the stock was trading just above 420. A couple of months later in the summer, it was trading just above 560 or so. Here we are at this kind of 480 range. We're almost like slap dab in the middle of this thing, but it looks like there's some tension building.
Yeah, that's right. I mean, what we know, of course, this is a different model and it always commands a premium for that reason, because the membership is very, very sticky. I've always wondered, and one of the largest shareholders of all time was Warren Buffett. He abandoned it years ago. I was wondering why he doesn't buy it out. He's got all that cash sitting around. In any event, what do we see? We see, of course, a well-defined series of lower highs and higher lows working into the apex of formation. So let's draw those lines. And what we know is, of course, it's going to be decision time or breakdown or breakout time. Let's put the arrows in to make it even more sort of obvious. And what happens remarkably is that you get news that resolves the patterns, but the patterns set up and tell you that something is going to, and I think it's jump ball here. I mean, obviously it's closer to the lower bound than it is the upper, but it reflects the market. There is a huge standoff between those who say the mighty Costco is always going to be around. You rarely get a chance to buy it, some 20% off its high. And there are others that say this is just, too expensive, and it will go down if we go in a recession like everybody else.
That's the chart, though. I mean, that's clearly it. You have a series, if you look going back over a year, series of lower highs, but you also have a series of higher lows. And we're coming into this pennant formation where, quite frankly, it could go either way. I mean, the subscription model suggests 94%-ish retention rate, which is probably why they deserve that premium valuation. But how much of a premium is the question? And the margins come in at a certain point as well. Do they get squeezed on that front? I'll tell you, if you're looking to trade this thing, I'm not trying to sort of pass the buck here, Dan, but I think you got to wait for them to report. And whatever way the move goes, I think you sort of go with the move, because you're going to break out to the upside in a meaningful way or the downside. And once you sort of have a handle on that, I think you ride that wave.
Yeah, and the only thing I would say is, and that's kind of been my and your inclination throughout this whole earnings season, because if you get something wrong, like the A&F today, the Abercrombie is a great example. Is like, that business might be deteriorating, but it might be relative to the expectations. It might have been short interest was rising for this, that, or whatever, and you get your face blown off, and there's a good chance that it gives a lot of that back over the course of the next few months, especially if we have a more difficult consumer environment, a recessionary environment. So to me, like, there's no reason to be a hero and play a one-day move. And when I think about the Costco here, 3% implied move in either direction. Okay. And I look at that pennant that in the lines that Carter's drawing. If you get it wrong, and if you're bearish, it goes right back to that downtrend. And Carter's going to tell you it's just where it should be, right? I mean, like think about it, right? And if you get it right and you press it to the downside, okay, could it go down 2-3%? Could it go down 5 or 6%? I got to tell you, I don't remember too many times where I've seen on a one-day basis Costco moving more than 5% in either direction. So it's just, they're not great. It's just not a great trading idea. That just, in my opinion, especially picking a direction. So Carter, does that make sense to you?
Yeah, I mean, and it's the implied move suggests that I mean, what would really, not always is the implied move right, of course, but what would really be interesting is not strength, right? Strength would just leave you a little bit higher still in the formation, still between the converging trend lines. But weakness that was outsized would be bad, obviously, but it would start to further sort of subdue the recent very bullish talk on Wall Street. We have strategists throwing in the towel or raising their price targets, all this nonsense. And meanwhile, the market is a pair of twos at best.
Yeah, and I just make one last point. So when Guy pulled that audible on Target, you said, what would it mean for the broader market if this thing were to break down? And I think that this is probably a great input into that broader sort of macro thesis, especially as it relates to a U.S. Consumer, which is why, unless you have so much conviction on this one name, it doesn't make a whole heck of a lot of sense. So to me, Carter, we appreciate you. We appreciate your insights. We appreciate your charting. You guys know where to find them. That would be at
Worth Charting.
WorthCharting.com.
No emojis, no hearts.
Just charts.
Bitch.
All right.
You got to put that part.
All right, bud.
That'd be so
Thanks,
good.
man.
I love that part.
All right. So this is probably it's a Wednesday.
I'm not going to say anything now because we want to make this professional.
Yeah, we do. Because this guy, I mean, like, he's up there on your what do you call it?
Mount Everest, the Pantheon, the Parthenon, Mount Rushmore, Mount Everest. Hey, I'm sure, you know what? In a past life, Butters probably climbed Mount Everest.
All right, let's
with
do
no
it.
oxygen.
All right, so about once a month, we get a guest on our show. We get really excited about. We get to read his work each week. We get to preview his earnings insight blog on our Thursday market call, which drops on Friday. You can find it at the FactSet blog here. But this would be John Butters. He's the senior earnings insight analyst over there at FactSet, joining us live on the program. Butters, welcome.
Great to be here. Thanks for having me.
I love John Butters, by the way. Was I right? Did you hear me earlier talk about the Memorial Day weekend barbecue you will be at and how you'll be approached by random people at said barbecue?
I'm going to try to escape to New Hampshire to avoid that because I just can't have the, but
we should have made
it could be everywhere now.
John,
so
I'm going to throw this out there and maybe we can put them on both the RiskReversal website and the Facts #Butters t-shirts.
Listen, we will do that. I doubt our friends over at FactSet are in the merch business, but well, who knows here? All right, John, you know this. We've been tracking your earnings insight blog throughout earnings season. And actually in the lead up to it, it was really helpful when you think about what expectations were. Okay. You have a report out. You're kind of thinking about on a Q1 wrap basis here, what were some of your big takeaways? Because we were tracking your data. We know that the average, decline that we saw over the course of the quarter for S&P 500 earnings was greater than we had over a 5 or 10 year sort of period. But we came in better than that. So what was kind of your take into the end of the quarter, the way estimates came down, and what most S&P 500 companies reported?
Yeah, exactly. One of the things that really stood out this earnings season was we saw a much better performance of companies versus estimates relative to what we've seen the last few quarters. So overall, 78% of the companies beat the estimates for Q1. That was much better than the 69% we've seen the last few quarters and better than the 10-year average of 73%. And also the magnitude of the beats was much higher. So overall, companies beat by about 6.5%. Again, if you look at the last couple of quarters, they were in the 1 to 2% range. And what's interesting is one of the drivers of that was the much better performance from some of the mega cap tech companies. So, for example, Amazon and Meta Platforms missed earnings estimates 3 of the 4 quarters in 2022. Alphabet missed in all 4 quarters. This time around, all those companies beat the estimates. And as a result, we got a higher beat percent or higher surprise percentage. And like you mentioned, Dan, as a result, we went from an expectation of an earnings decline of about 6.7% coming into the earnings season. We're at 2.2% decline now. So we're still going to have those 2 consecutive quarters of earnings declines, but a much smaller one for Q1 than what was expected coming into the earnings season.
So I look at this, John, and maybe you have thoughts. I don't know. Maybe the analyst community just got themselves too negative. Now, to your point, I mean, there was an inordinate amount of companies that beat, but they beat extraordinarily lowered expectations. So, although there were beats, if you really look at it in terms of where we are, things still aren't great. I'm sure your work probably suggests something like that.
Yeah, I mean, the numbers, so we did see certainly much more negative guidance this quarter than we'd seen the last couple of quarters. The estimate revisions were fairly consistent with what we'd seen in Q3 and Q4. So I think it's always that interesting debate where, our estimate's too high, our estimate's too low. And typically the trend is they're a little too low in the near term, a little too high in the far term. And I know we'll have a chart a little bit further on talking about the revisions going forward. But it is interesting when we look at those revisions, net, the upside to the earnings for Q2 offset some of the negative revisions we've seen for Q3 and Q4. So if you look at overall for 2023, we're looking at about $221 per share coming in the earnings season. We're basically at $221 today. And I know you guys talked about the trading range we've been in that 4,100, 4,200 range. So the forward PE is at 18, and we really haven't seen that change very much from March 31st through today. Still at 18, which, again, depending on the comparison, it's lower than the 5-year average of 18.5. It's above the 10-year average of 17.3, above the 20-year average of 15.5. But it's interesting that we've gone through this whole earnings season, and for the full year, we're basically no change from where we were coming into the earnings season in terms of the earnings expectations.
So, John, you just mentioned that, a bunch of those big mega cap techs are huge contributors to S&P earnings, right? And so the beats that we saw, especially after a lot of the misses that they had last year, right, has really kind of helped power, that kind of beat rate. When you think about that, okay, and you think about that 18-ish multiple that you just talked about, which is basically in line with the 5-year average, and it's just a little bit above the 10-year average, and you say to yourself, okay, is that appropriate right here? And I'm not asking you to opine on the valuation, but when you think about the equal weight S&P and how much lower its multiple is, do you ever think about that a little bit? Because I think at its lows, the equal weight S&P, I think bottomed out when the S&P was at its lows in October, somewhere in the kind of low teens, if you will, the 13, 14 times or something like that, because we get pushback all the time that we're waiting for that 220 number to get below 200 and have a trough sort of multiple that looks mid-teens on that, which gives you an S&P that's much lower than here. And I'm just curious, do you think sometimes, do you ever X out some of the big contributors or smooth them out a little bit and think about it in equal weight terms?
Well, generally speaking, when we do our analysis, we do look at it on an earnings weighted basis. So the companies with larger earnings are going to have more weight. We typically don't look at that on an equal weighted basis. But, to your point, I think it's interesting if we can pull up that chart that shows the earnings growth rates over the next couple of quarters and where they were on March 31st. Analysts, even though the numbers have kind of come down a little bit, we're still looking for a second half recovery in earnings, and obviously particularly in the fourth quarter. And we did a little bit of a deep dive into that Q4, and the companies that are expected to drive earnings in Q4 are these same mega cap companies that we've talked about that had the surprises in Q1 that have really been driving the S&P 500 increase in price since the start of the year. The biggest drivers of that earnings increase are expected to be Amazon, Meta, Alphabet, Apple. So again, how much faith does the market have in seeing those earnings actually pan out in Q4? That's where the expectations are. Those are the companies really expected to drive growth in the fourth quarter. And obviously, we'll have the second quarter earnings season come up. We'll get sort of an update on where these numbers stand. But those are the companies, again, expected to drive that 8% growth in Q4. So we'll see how that plays out, over the next couple of months.
John, it's interesting. The middle slide, which we should take a look at, speaks to the growth in certain sectors or lack thereof in others. And I'm struck by the two extremes. Consumer discretionary, to your earlier point, is sort of off the charts in terms of its earnings growth. And there are probably a number of reasons which you talked about. But the flip side of that is materials. And that speaks to something that Dan's been talking about the economy, the global economy. And if materials are getting whacked like that, again, to me, probably as economically sensitive a space as you can find on this list, maybe industrials as well. Speak to the importance of materials, if at all.
Yep. So we look at materials. I mean, that's really weakness across the board there. Metals and mining, chemicals, they all had significant declines. And I think, in conjunction with materials, if we look at the energy sector, 14% growth this quarter, but I think it's really important to note this is the last quarter of growth for energy. As we go through the rest of 2023, the energy sector is expected to be the biggest drag on earnings, looking for, earnings declines of 20% to 40%, depending on the quarter you look at. And, part of that is the commodity comparison. Oil prices are around, 70, 75 now. If you go a year ago for Q2, those are up in the $100 range. So I think when you look at, we're certainly seeing weakness in commodities when you combine materials and then energy going forward. On the flip side, in the consumer discretionary sector, we've talked about this theme a little bit in the past. A lot of the growth there coming from Amazon, which had some easy comparisons a year ago. Take Amazon out, that 54% drops down to about 16%. But another driver of consumer discretionary, we're still seeing the hotels, the travel, those companies are all doing well. All those companies either had profits this quarter versus losses a year ago, or much smaller losses. So if you take out Amazon, take out those hotels, restaurants, and leisure, that consumer discretionary 54% growth becomes a decline of about 6%. So a lot of growth in consumer discretionary really concentrated in Amazon and the hotels and restaurants. And again, we'll see how that strength is supposed to continue through this year, but the comparisons will get more difficult. And we're not looking for the growth rates will decline as we move forward, but consumer discretionary is still expected to be a positive contributor through the rest of this year.
Well, I'll just say this, going back to an appearance that you probably had late last year with us on Market Call, you were telling our viewers that, if you were reliant on energy as a major contributor, okay, to S&P earnings and kind of kept them in the game last year, so we didn't have double-digit declines in 2022, they're going to drop off at some point in late Q2 into Q3 of 2023. And that happened. So when you start talking to me in the same way about some of these discretionary, some of the services or whatever, you got to have your antennas up to see for some sort of weakness that might, happen if we are obviously headed into a recession, if China locks down again. All those sorts of things would impact that sector most definitely. Okay. John Butters, the man, the myth, the legend. He's the legend. I mean, that's it. Okay. You guy loves him. I love him. Our viewers love him. John, we really appreciate you coming here. We appreciate all the work that you do over there at the Earnings Insight blog. And we appreciate our preview that we get to do on Thursday.
Yeah. And listen, I don't know this, but it sounds like John's going to wait for it, Dan. Lake Winnipesaukee.
Yeah, there you go.
Is that accurate?
That's a great guess, Dan. A guy. How did you know? Yes, I'll be up the Lakes region. Lakes region.
That's what well, you don't want to too many people know, because they don't. Those streets they're not equipped to handle that type of traffic.
You know what? And you just named the episode. What about Butters?
What about Butters?
You see what I did there?
I see what you did there.
Okay.
That's
all right.
fantastic.
John Butters.
Love
He's
John
the senior
Butters.
earnings insight analyst over there at FactSet. John, thank you very much for being with us here today. We appreciate it.
Great. Thanks again, guys. Appreciate it.
He's the man. All right, Guy. Let's hit two names that are near and dear.
I know what they are.
I know.
I don't even need to look. I know what they are.
I know.
We rarely talk about a certain stock that seems to be driving Tesla today, but let's take a look at this. XPeng.
Yeah. So one of the big themes in I think in Tesla's Q1 was this price war in China. They have a car that is not nearly as refreshed as many of the local manufacturers there. Okay. And the Chinese consumer really cares about the new, latest, and greatest thing. They also care about US deemed to be luxury aspirational brands, that sort of thing. With Tesla, that had been a big story here. But then when some of those local competitors were having their lunch eaten by Tesla, they started lowering prices, right? And so to me, The margin issue with Tesla is something that I just don't think, and you and I talked about this, it's not going to be a one-quarter thing.
No.
They had 25.5% gross margins last year. There was nearly 10% above, let's say, domestic manufacturers here in the US. And we know Ford told us they lost $3 billion last year in the EV space. We get it. But let me just tell you this, people. This price war now with automotive gross margins going down possibly into the mid-teens for Tesla right now, this is a problem because you saw their cash flow. It dropped like what, $2.7 billion, okay, year over year in the quarter, and it would have been negative if they didn't have the EV credit. So to me, there's a problem here with Tesla that some folks just don't want to acknowledge.
No, we might as well take a look at a Tesla chart. Because
and the point was that XPeng had really bad results. All those names, NIO's down 10%, XPeng's down 10%.
And Tesla's not being spared from that. And we talk about, for me, the battle line for margins was going to be around 20%.
Yeah.
Now, to Tesla's credit, in the fall of last year, they said our margins are going to start to come down, but we won't approach the levels that the legacy automakers are at, 16-ish% or so. Well, guess what? It's getting there. And that's a problem.
All right, so here's
because then you have to question their valuation.
Okay.
Understanding they deserve a premium valuation, but what is that premium?
So the stock filled in the gap, okay, post its Q1 results, the gap from January results, okay? It got down to like 155 or something, and then it was like a rocket ship up to just, so we have that chart up there. You see that downtrend that's been in place from the February highs here. That 200-day moving average is downward sloping, so it's going to be right near that high pretty soon. I'll just say this, guy. When I looked at the stock on the opening down 3.5%, it was not lost on me, okay, that Elon Musk, who's the CEO of Tesla, yesterday was announced that Ron DeSantis, who's the governor of Florida, is announcing his presidential bid on a Twitter Spaces hosted by Elon Musk, okay? And when you think about Ron DeSantis in this tit for tat, like culture war, and it really is a culture war with Bob Iger, the CEO of Disney, and you think about who the natural buyer is of an electric vehicle, they believe in things like climate change, okay? Some Republicans, and this is not political, this is just a fact, okay? Like Ron, they don't want to acknowledge those sorts of things, although his state might be underwater in 50 years from now if they don't acknowledge it soon enough. So I guess my point is that there's a certain contingency of Tesla owners and maybe future buyers might be really turned off by the fact that there's a governor from Florida who passed a bill that says don't say gay in their schools, in their state. And Elon Musk, the CEO of Tesla, is hosting him on his other platform. And I know that there's some people, I'm sure that our comments are blowing up, but this is truth. Do you agree with that, guy?
Well, I mean, think to you, with the point you're making, and it's probably correct, that he could turn off potentially half of his potential customer base, by definition, by going down this route.
But this is why he supposedly announced a new CEO, Linda Yaccarino from NBC Universal, to be the face of the company.
I don't know why he would host that Twitter space. It makes no sense.
It makes no sense, right? Like think about that, right? So like to me, I just think that again, this shows you nothing has been fixed. If you're worried from a Tesla shareholder standpoint that he has been too distracted with stuff over there at Twitter, and he's waiting in some areas that is not going to be something that the natural Tesla buyer is into, like it's kind of a problem here. And I've said this again and again, and you guys know I'm short and, and fine, whatever. I mean, there's two things there. Fundamentally, I think there's definitely, this price war is not ending anytime soon, okay? I think the fundamentals of this company get worse before they get better. And if we have a recession, it's lights out.
And if you listen again, if you look at a longer term chart, the stock was over 100% bounce from the lows. We've acknowledged that. I mean, I'm the first to say that I thought the stock on the way back up would probably stop around 155 or so. It traded up to 2.25-ish. It's given it half of it back. And if you go longer term and look, this is not a particularly good looking chart. I mean, this stock is still challenged from the all-time highs it made, not coincidentally, in the fall of 2021. So you can say what you want, and that move got everybody geeked up from 103 to 2.25. But here we are right smack in the middle of that range, and it has effectively been upper left to lower right for the better part of 8 or 9 months now.
Yeah. So, I mean,
longer, really.
Again, I find this one interesting. It's still a $580 billion market cap company. It seems to be, it's a huge component of the S&P and the NASDAQ. And that's why this one remains important. But I just think it's really interesting because I've said this again and again. Tesla shareholders shareholders bear all of the risk of everything that he does outside of Tesla. And the Twitter thing is just an outsized risk. And when you think about why is he getting so into the weeds of the politics of this thing, he'll probably say, I'll host Joe Biden. I'll host Bernie Sanders. I'll host anybody. But is that the sort of platform that you want the CEO of this company over there at Tesla, which is the only publicly traded company that he sits as the CEO and the chairman of? You know what I mean? So to me, that's that. Okay.
That's it. But the one, yes, and we'll see. It has not didn't trade well yesterday, and it hasn't traded well today.
It reversed on the China
Yes.
news, on the
Yes.
news that maybe there's going to be further lockdowns in China, that sort of thing. And so again, China is a huge issue for this company. It's a huge source of future growth. It's a huge source of access to rare materials that would go into their batteries. It's a huge source of their manufacturing, and it's a huge source of demand as it relates to consumers. And I just think all of those things are going to be really challenged.
It's a growth engine for a lot of companies. Now, before we get out of here, NVIDIA, we've been talking about this now. So here's a trend line, folks. Take a look. And you can, if you can say NVIDIA is going to be the next $1.5 trillion company on its way to $2 trillion, the most important company. Maybe it is. I do not know. I mean, I will tell you, though, a lot of this move, it's been basically multiple expansion. Go back and look at the last quarter. It was great. It was not by any stretch this good. You see the moving average is sloping higher, which is encouraging. We're up against a pretty steep uptrend line. I don't know what to tell you. I mean, knock yourself out, as you say. I mean, I'm sure a lot of people want to roll the dice and stay long into the print, saying we're going to wake up tomorrow, it's going to be a $350 stock. Maybe. It's an expensive stock. And I don't know what they could, again, I'll say this, and I'm going to look like an asshole tomorrow if it's up 15%. But for the life of me, I can't imagine what they're going to say. And by the way, NVIDIA, the company, actually made reference to U.S.-China relations and how potentially devastating would be for the semiconductor industry, blah, blah, blah. So I look at this and say, if you're long the stock, if you've enjoyed this ride, which I've clearly missed, you got to be disciplined and pull the ripcord here.
Well, I've been short of it, and I'm really hoping that it breaks that downtrend. And a lot of it has to do with this, like expectations. And I got to say, like my tone about NVIDIA relative to, let's say, a Tesla over the last 3 months has been really different. I don't have a bone to pick with this company.
No.
When investors are the ones here
who bid it up.
They're the ones willing to pay 25 times sales, 67 times earnings. And I guess if the company comes out and just says, hey, listen, like your expectations, this is analysts and investors, are just too high, right? We're expecting, let's call it 20% revenue growth, 30% EPS growth. And they guide below that. I mean, this stock's going to open at 275 tomorrow. Okay. And so you tell me if they're able to come in line and, let's say, guide in line, where's the stock? Does it make back a little of the last couple days, decline? It's down about 5%, maybe. I don't know. The implied move in either direction is about 7%, $21 or something like that. So I think the risk of like a gap and just, like blowout, it would take the most miraculous quarter in guidance that you can imagine. What's the all-time high, though, guy?
350.
Yeah.
I think it got close to 350. You'd have to go back and look. I think it happened, I want to say, in the late summer of 2022 or something ish. But I got to go back and look.
You know what's amazing? Short interest is like 2%. Isn't that
nobody's short?
Isn't that fascinating?
Yeah, nobody's short this name.
Yeah.
So we'll see. I mean, maybe this, I will tell you though, if you go back and look, I mean, we've had 30, 35, 40% peak to trough declines in this stock over the course of a couple of weeks, at least 3 or 4 different times over the last 4 years or so. So
Q4 2018, when the S&P sold off 20%, the stock got cut in half. It
Yeah.
went down 56% or something like that. I'll just say this. I mean, we just said, the whole thing about being a hero into prints and this, that, whatever. If you just look at the weekly straddle 300, that's where the stock is trading. The call premium plus the put premium, it's about $20. Let's call it, okay? $10 for the call, $10 for the put. It's a $300 stock. You're risking 3.25%, whatever. You know what I mean? Like, that's the way to do it. If you have conviction in one way or another, that's the way I'm kind of positioned, but I also have a longer term sort of position on this one too. But again, I mean, this kind of flies in the face of, what do you call it when you're betting and you're just kind of pushing it? You have a name for that.
you just playing with house. What?
No, because I don't have gains in this one. I've got when you're back against the wall, you just got to kind of take a crap at it.
I like that.
You know what I mean?
mean?
That's what I'm doing here. So a little
Okay,
bit.
well,
I'm
that's
just saying.
okay. Sometimes you got to do that.
No, there's a name for it. We've done it with Danny on the pod a little bit,
Danny Moses,
yeah, Danny
of
Moses,
the Big Short fame.
of the Big
By the
Short
way,
fame.
he shares a podcast with us. Drops on Fridays at your favorite podcast
on
store.
the tape.
I heard that the other day. Somebody said that, and they snickered the way I
Yeah,
snicker
because it's
when
goofy.
'cause
I don't
it's a
know.
dumb
Somebody
thing to
said it
say.
once, and then other people started repeating
I
it,
didn't,
and then it became a thing. Well, you do say it.
because
You
I say
just said it.
I say because of the absurdity of the whole thing.
I feel like you and I could do this all day. Do you think? Hey, if you're here, throw some comments in there. If Guy and I just turned the mics on and we just did this all day, would you
nobody
guys,
wants to hear that.
No,
I'm
really?
looking at the
Yeah,
pressing your bet.
pressing your
Kenny
bet. That's what I
Wilson
meant. That's
says.
what I meant.
Well, that's
That's-
I
I
thought
don't-
it was more like.
Well, I'm pressing, and I'm not pressing it.
Remember that
from
show,
a winning.
Press Your Luck?
Yeah.
Do you really? No
Yeah.
whammies.
Yeah, no whammies.
What
no
a
whammies.
I mean, you talk about a show that
You've
was
done that.
effing rigged.
Yeah,
It's such a dumb game. It really is.
yeah.
It's
You're
funny.
a big match game guy because you like to
Gene
say,
Rayburn was the man, and Richard Dawson.
Yeah.
Nobody really knew who Richard Dawson was. He was obviously on Hogan's Heroes.
Was
If
he?
you oh yeah,
I wasn't around then.
they're on Hogan's Heroes is on twice a night now. I watch it religiously.
But Richard
Like,
Dawson was the host of Family Feud.
well, but he was on. I'm telling you, go back and look. And all the contestants, when their life was on the line and they needed to match somebody,
Yeah,
they weren't going to effing Fannie Flagg
yeah.
or Brett Summers
Yeah.
or CNR. They were going to Richard Dawson. By the way, CNR is Charles Nelson Riley,
do
who
you
I
have
effing love.
any sense for like what the
Amanda's like, by the way, I'm sure
fine,
Amanda's
fine.
losing
You
her
guys,
mind.
you guys can all leave. We're just
No,
gonna
nobody should
we're,
leave.
No, we're just gonna keep talking.
I'm not.
But Guy, do you have any sense at the time when Richard Dawson would say, "Survey says"? What was the quality assurance process for that survey?
That's
Like,
dumb.
what went into that? Like, who did they survey?
Family Feud sucks.
But who did they survey?
Like
that's what
100
I wanna
random
know.
dipshits.
Yeah, but for every question,
I
for
don't
every
know.
question on that show that was on 5 days a week.
I don't know the answer to that. I mean, maybe it was just their producers in the back.
Do you remember that movie quiz show?
Sure, I
think
do.
Robert Redford directed. Is that right?
Was Redford?
I think so. And it was Ray Fiennes and maybe
John Turturro.
John Turturro.
Don't mess with me.
I think that was if I pulled Robert Redford from that
Probably
thing,
true.
but that was based on a true story.
Sure
about
it
a
was.
yeah.
And they sequestered, like I say this all the time. When I used to do Squawk Box and used to or
Squawk
one of
and
those
Friends.
shows and they put
Yeah.
me upstairs, I would say, I don't know the answer because I'm sequestered like Charles Van Duren.
Robert Redford directed that movie.
Charles Van Duren, of course, being the protagonist of that movie.
Yeah, he was.
And he was probably, in some ways, was he a villain or was he a hero? Because in some ways, I think he made it cool to be smart. So even though he had the answers,
Yeah.
he had a generation of people that want to be as smart as Charles Van Duren. So maybe there was a greater good shit going on there.
Here's an actor that really didn't make it out of the 90s, Rob Morrow. He was in that movie. He was like,
Yeah, I know him. He was the
Morrow.
guy that played the FBI investigator. He was the guy investigating Charles Van Duren.
Right. But like
He
John
was an asshole.
John,
Who is it hurting?
yeah,
Tell me.
victimless crime. Are
No.
you
Don't. I see what you're
well,
doing there.
I'm just saying.
As I said, Van Duren wasn't hurting anybody.
Yeah.
Now John Turturro said it hurt him,
But you know
but
what
he
it
was a
did?
sweating idiot.
Yeah. But you know what it did? It shook when you think about how few
Shook the
out-
foundation.
well, when you think about how few outlets there were.
Rafus
right,
is
to
in the
talk-
back. Rafus is doing helicopters with his head. So bored.
Every bit of this is over his head. I'm just telling you, like every
Guy
bit.
is, by the way, I see somebody here.
Yeah.
Guy is the best Trivial Pursuit partner ever. You're damn straight. You want to play Trivial Pursuit with somebody? You want to play with me?
Really? Do you still have it?
I watch Jeopardy at night just because.
Yeah. Do you like the Jennings guy?
Yeah, he's all right.
He's kind of a bore.
A little bit.
You know who they should do? They should get Will Ferrell, who did. You remember Will Ferrell on SNL?
Faber was
David
the best
Faber
one.
was the man. He was excellent at that.
That's what Faber.
What do you think about Aaron Rodgers? Do you think he should have been doing that over playing for the Jets?
He had an opportunity to do that.
He was on it. He did one of the celebrity things. Then
By the way,
same round as
I'm sure
Faber.
there's some Jet fans out there that are all geeked up because
Yeah.
they saw a clip of Aaron Rodgers scrambling for a
He's
touchdown
hurt.
in
He's hurt
practice.
already.
I mean, you people, as I said a number of times, let's talk in September when the Jets are like 1-3 or something
Yeah.
and sucking wind, and you're going to be like, "Why did we do this?"
Quiz show.
Show.
Should we do it?
That's it. Listen, I want to thank the following people. I obviously want to thank FactSet, our sponsor, financial data and analytics powered by Tomorrow.
Yeah.
They're also our data provider. I want to thank Carter Braxton Worth of Worth Charting. No emojis, no hearts, just charts. bitch. And I obviously want to thank the great John Butters, who will be in Lake Winnipesaukee, New Hampshire this weekend at barbecues. Good luck with that, John. Obviously, thank the audience, and buckle up for this NVIDIA number, man.
Oh, baby.
That's going to be must-watch TV.
Wait, any comments about the what about Butters? Like, because I think I nailed that, but whatever. You guys will figure it out on your
Sam
own.
says, nah, the Jets will be a contender today. Yeah. How many basketballs could fit in a bus from Robert Byers?
What does that mean?
I have no idea. Guy was surveyed. I love all this. I'm reading the comments.
You know, we have like a little community here, guys.
Of course we do. Community is important.
You guys should all, if we ever did an event in New York, a live market call, would you guys come? You want to come to that? We get some good
Guy
guests.
eats Chipotle farts. I mean, what a dumb. What are you? Third grade?
We could get some Chipotle burritos for lunch. You know what I mean? Like, it would be fun. Should we do an event here in New York? You guys be down with that?
I'm looking at the comments.
Yeah,
I love this. I don't know.
Let's just keep the video running.
I got to take a leak. No,
Right.
I'm just saying.
All right. So basically, they're going to cut all of this at the end from that point where you just
Butters
said
point?
goodbye. Yeah, when you said.
Oh yeah, and Amanda's losing her mind.
Yeah.
Not for 45 in Alaska. No way is that happening. You must be 18 over the comment here. All right. I like this matrix of compassion. You got to get a job because he's here every day. It's fantastic. It really is great. One day, can you guys bring what you're eating for lunch? I'm going to tell you something. Dan knows this.
Yeah.
I can't remember the last time I had lunch.
Well, here probably I made you eat like a half of the Italian
it was
hoagie.
good. That's same.
You call them hoagies, grinders. What do you call them?
Wedge.
Heroes? Wedge. Why wedge?
If you grew up in Westchester County, and I'm not a Harrison or Larchmont,
no, you are not.
West or Scarsdale or
That's
Rye.
more Tim Seymour.
Exactly. I grew up on the mean streets of Croton on the Hudson.
Yeah.
Okay. We had to steal our wedges if we wanted to
Really?
eat. Yeah. There was a guy that lived by, he had 5 sons and his husband and wife. So there's 7 of them.
Yeah.
And he put 6 chairs around the kitchen table. So you say, why would you have 7 kids? You have 7 people in the family. On the survival of the fittest shit there.
Really?
Yes.
The mom didn't get like
the
a
mom probably got
guaranteed
her
seat?
chair.
Yeah.
But then the kids got to battle it out.
Yeah. That's
a little crazy, right?
Really dark.
Well, it's
You know
fair
what
though. I mean, somebody ain't eating that night.
Yeah. We called them submarine.
Yeah.
So there's hoagies, there's grinders.
This
there's
is an
subs,
outro,
there's
by the way. Mika
wedge.
said, is this considered an outro?
That's Micah. Mika would be Mika.
Mika Brzezinski.
Yes.
All right.
Yes. That's Micah.
Amanda's okay.
Amanda's
Amanda's like,
just said, "See you
okay, let's
tomorrow."
sign off.
Let's keep going.
Okay, that's
Let's keep
it.
going.
We'll see you later. Bye, everybody.
Thanks, everybody. Bye.